Good morning, everyone. Thanks so much for joining today's webinar. I'm Laura Milojevic. I'm the Director of Marketing and Business Development at Simplify Solutions. Today, we're excited to have our Managing Partner, John Essig, discussing intercompany planning and transfer pricing using SAP Analytics Cloud. So after the webinar, feel free to reach out to John or myself if you have any questions. And now I will hand it over to John so he can get started.
All right, great. Thanks, Lauren, and thanks everyone for joining. Thanks for the introduction. So yeah, John Essig from Simplify. Have been implementing planning, analytics, consolidation solutions for now the past decade plus, and have personally implemented transfer pricing, production planning for your financial plan and for your financial annual budget forecast at a couple different companies now. So excited to take that content that we've seen deployed successfully and build it on a prepackaged accelerator with SAP Analytics Cloud, which should hopefully help companies see, how they could leverage this solution like other companies have successfully, and how they can optimize their planning processes around these requirements. So we'll start, we'll spend a couple minutes just reviewing the use case, the business problem, and we'll give you a little insight into the metrics and savings that other companies have seen with this solution, how this can impact and improve your planning processes, what's included with our prepackaged solution, and then some prerequisites just so you know what you would need to be able to deploy this. So the use case, transfer pricing, production planning, it relates back to your financial plan for companies that, have multiple production facilities across country borders, across state borders, can be a very time-intensive process, right? So if I'm in the U.S. and I have a production facility in China and a production facility in Canada, and maybe I'm trying to make decisions around changes in those facilities, standing up a new facility, where do I make what, and at the same time trying to come up with an actually model and plan for, the U.S. North America sales itself. It can be hugely time intensive just to get aligned as an organization on what is our sales and revenue plan, but then to translate that back to a legal entity plan that includes all of the intercompany impacts and profitability impacts depending on who you use and what are the tariffs and what are the markups, can be hugely time intensive for companies. So have seen, this take companies, during an annual plan process or during a forecast process, weeks, to be able to take that third party revenue plan and translate it back into that legal entity and intercompany plan that's associated with that. Doing that all offline, it's hugely time intensive. So that lengthens your forecast process, that lengthens your plan cycles. So, instead of, having a best in class, planning cycle of, 30 to 60 days, right, that's automatically adding 2 weeks onto the end of it. And then what happens when management comes back and reviews that and wants to make adjustments to external sales? Well, to get the plan right so that you have a valid plan, you need to matriculate those changes back throughout your entire organization. So a lot of manual effort behind the scenes to get this done. I've seen this, be done by the supply chain group, be done by the finance group, done fairly centralized in the black box. So there are a lot of times there's inability to see what those actual assumptions are, and that just the results are being loaded into a planning system. So this solution is helping with all those points. Inability to model profitability and tariff impact based off of these changes, right? And difficulty matching up. So what this solution provides you, this is utilizing SAP's Analytics Cloud. It provides you a process flow to guide the admin and users throughout the planning process. Provides you the ability to do driver-based planning around these assumptions. So instead of, extracting all this data to Excel and then, trying to figure out the impact, and, you might have a situation where, the U.S. is selling this and then Canada is going to produce, 30% of this product, and then they're going to procure a semi-finished good from another country, right? So doing this all in Excel can just be, it can be too much, right? So having this driver base in a solution like this allows you to handle those multiple bill of materials type situations in addition to that, right? So driver-based planning, scenario modeling. So if I want to change where I'm producing what, if I want to change our markups, and within this tool, you can easily make those adjustments and then see that matriculate through your plan in seconds, literally instead of weeks. So as far as project metrics go, this is what we've seen companies, that I mentioned earlier, be able to realize from an implementation like this is going from 1 to 2 weeks at the end of their forecast or plan down to a few minutes or a few hours, depending on all the assumptions that they want to kind of model and look at changing. So applies to a myriad of different industries. So what's included with this solution are standard planning templates, standard calculations to help you take your external sales, identify where you're producing it, create and automatically create the entries based off of that, all the way through your P&L, right? So we have pre-configured what we call data actions in SAP Analytics Cloud based off of your planning assumptions that go and handle all of the accounting entries for you. And then on the reporting side, not only are you able to, within this tool, generate those downstream entries for intercompany revenue, intercompany costs, but then you're also able to automatically eliminate and consolidate those entries within the solution, be able to report on, print-ready consolidated statements with those consolidating entries incorporated. And, when you run this logic, again, as opposed to waiting a week or two, you have the results available for you immediately. So what's required for this solution? This does require SAP Analytics Cloud planning licenses due to the nature, obviously, of the system. We can hook this into any structured data source, so we can plug into and create a model, based off of Excel. We can create a model based off of S4, based off of BW, based off of any third-party data source. And everything that you're seeing today is included. This can be deployed, basically on a gap fit approach in a matter of weeks. If you want to custom tailor this solution based off your specific, requirements, then an implementation could be, 3 to 5 months, right? But you can get up and running in, 4 to 6 weeks with our standard solution, off the bat, and then identifying any gaps too. So there's a couple different ways to approach things. All right, so we're going to go ahead and jump into the demo. So for those of you familiar with SAP Analytics Cloud, the main interface here is utilizing a Google Chrome browser, right? So we log on to SAP Analytics Cloud, we see our menu button here. Within this tool, we can create stories, visualizations, planning processes. We can do data modeling, data integration, right? This is SAP Analytics Cloud is a robust planning, analytics, modeling solution with all the capabilities you would expect from a legacy tool, and you have a lot more flexibility with this solution too. But I'm not going to go through too much of an overview here. I'm going to go ahead and jump directly into the process we were discussing. So I'm going to go ahead and click on my catalog. And the intercompany planning process is part of our sales and margin planning process flow. So I'll start here. So obviously as an organization, you can use SAP Analytics Cloud to do your sales planning, to do your revenue planning, to do your costing, and then to take those third-party assumptions and translate that back into a financial production plan and intercompany plan, right? So before I jump into transfer pricing, I'm just going to take a quick look here at our P&L kind of target setting and plan setup, right? So at the beginning of our planning process, we can start really from a blank slate, and then we can pre-populate our plan data, and we can also do that with data actions. So this is utilizing our prepackaged content for sales and margin planning. So right now I have last year's actuals. Our budget is right now blank. We have a 2019 forecast. I'm going to go ahead and see targets for our 2020 plan. So I want to post the results from actual, carry that forward to a target version. And that way we can start to look at, pre-populate the plan and start to do some scenario modeling on the solution. So you see down in this quadrant here, our target for our budget was blank, and that data action has now populated our data for all of our company codes across our entire organization. This is a high-level view of this target data. We have what we call a page filter on the left-hand side of the screen. We could change this and just pick a specific country, and our target will actually update pretty quickly here. We can adjust our target at a macro level. This data is actually going all the way down to product SKU and customer ship to level of detail. But this is our total company view. We can make small adjustments to this target. If we say, hey, that's just at a top line, we want to add 5% to our net sales based off of history. We can do that. And again, that matriculated down to all those 40,000 values and SKUs beneath it. So very dynamic, very flexible. That allocated pro rata, that adjusted target when I added 5% down to Canada, as well. So this is one way we could pre-seed our data. We can also pre-seed our data with different, predictive scenarios. We'd be happy to, take you through that on another, presentation. But, just wanted to at least show you guys how to kind of set up the budget from a starting point. So this is our target, our annual budget that we're going to work through. We have pre-populated our sales volume. We don't have our net sales and COGS. We're going to build that from the ground up, but we're starting with the assumption of our volume plan at this point is already completed. So I'm next going to launch into our intercompany planning process, and we have a number of steps in this process. So at this point, we have our intercompany plan for our volumes, and now what we want to do from a production and intercompany planning perspective is identify, for example, if I'm in the U.S. or North America, by specific product line, what am I going to make? What am I going to buy, either externally or buy, internally within the organization, right? So we can go through that make versus buy decision-making process, and we can load our assumptions into a planning template. So if I click on intercompany purchase percent, within this planning template, we have the ability to identify by the selling company. So if you look on the left-hand side of this grid, we have identified our selling company. We're going through this process for North America, which is what we have this filtered on in this example. So North America is our selling company. So we have a third-party sales in North America, third-party sales for shower gels, for example, right? We now come into this grid, and across the columns, we can identify what we're making versus what we're buying. So if we're making 100% of, the body lotion that we're selling, we just leave this blank, right? And then this is going to follow through the standard costing and margin planning process that we have as part of that part of the application, right? We're just focused on the transfer pricing piece here. Instead, here, what we're saying for shower gel, for example, is we're going to make 25% of that product overseas in Europe in our German sister company, right? So these are assumptions and drivers that we can plan and change dynamically and then recalculate, and it'll regenerate not only intercompany revenue, but also intercompany volume and costing based off of this. So I can change this assumption. Right now we're saying 25% that we just have preceded, from our actual data or from our plan. I can change that to be 33% by just typing that in and saving it. And right now this is saving this back to the database. I could go ahead and publish this back so that everyone can see the results. But I could also just go through this planning process in my own kind of local version and see the results of it and then publish it back when I'm done. So I don't have to publish it back on this screen, right? So we are saying, again, our third-party sales 33% of our shower gel we are going to procure from our sister company in Germany. And we can see the shower gel sales, for example, for our North America company. This is our sales volume plan, just a quick kind of report showing what those third-party numbers are. So at this point, we've input our percent of what we're going to make, what we're going to buy. Next, we're going to go and input our other drivers, such as our intercompany markup, right? So from Germany's perspective, we are producing the same product as shower gel. So now we're looking at from a producing organization perspective for Germany. We're producing that shower gel and we're selling it to our North America sister company, right? So if we had no markup on this product and a straight cost transfer, we could just enter in a zero here. If we had, a 19% markup, you could enter that in. If we had a 15% markup, we could enter that in. We could change these assumptions. And again, these are going to drive our downstream calculations for our intercompany plan. So when I enter 15% here, this is going to take our costs that it costs us for Germany to produce a shower gel, and it's going to add a 15% margin on top of that cost. So you can plan this, a couple different ways. This is a very kind of standard approach that organizations take. You can set these rates centrally from a corporate perspective, or you can have your companies come in here and input these percents based off of what they've agreed upon. From my experience, it's typically been done more at a corporate level, where it's agreed, with the subsidiaries, and then corporate governs these rates that normally stay constant throughout the entire year. So once we've entered in those markups, we've identified where we're making our product as North America. We've identified what is Germany's markup when they sell the shower gel to North America. And then we're going to go ahead and calculate our transfer price calculation. So calculate our intercompany volume, calculate our intercompany revenue. So here, this is just a simple report, which is showing the producing entity in our rows. So we see Germany, we see shower gel. We have not yet run our calculations for the intercompany production. So we see, Germany has, sells shower gel with third party to, within Germany as well as within Canada. I'm sorry, this shows the intercompany production rates that have been identified earlier. So we had input that 33%. Within this quick validation report, this is showing for Germany, we have this driver entered. We don't yet have the associated intercompany volume calculated. But then Germany also has just regular third-party non-intercompany sales, with France and United Kingdom direct ships, right? So we're going to go ahead and calculate our transfer pricing data action. So we run this data action, and what's happening when we run this is SAP Analytics Cloud, based off of those drivers that we loaded earlier, is going and calculating and posting volume, intercompany volume sales to Germany based off of that 33% that has been loaded into the system that North America is going to source from Germany. And then it's actually going to, so we can see these columns now have expanded, and we can see this 2.5 million in volume that we have identified that Germany will be selling to North America added. And if we scroll down here, we have an offsetting entry for North America of 2.5, so that we know we're sourcing that from a, we don't need to go through the standard costing and revenue calculations for that volume, because we're going to get it from another, from our German sister company. So that's the next tab on here we look at, we saw the volume entry that was automatically entered into the system. Here we can evaluate our underlying costs. So we have our producing company of Germany, the shower gel and the sale to North America. We have our volume, we have our standard cost, and this is essentially just taking the volume times the standard cost and dollarizing it, right? The last part of the calculation, so it's taking the volumes, automatically posted that for us, it's dollarized the cost, and then it also generates the intercompany revenue. So it takes that standard dollar cost of goods sold, it adds the 15% markup that we loaded earlier, and calculates this in local currency, but then it also calculates and posts this, translates it to US dollars. So that was part of that part of that data action that we showed a little bit earlier. So again, it's posted the volumes, it's posted the cost, posted the revenue, all for us dynamically, automatically based off of those drivers. So we've loaded our drivers, we've calculated our results, and then we can also consolidate and match and interlock those results between the subsidiaries so they know how interdependent their planning process is, right? What numbers, what Germany can see how their plan is being impacted by the U.S.'s assumption right here live within the system and interlock that together. So here we can see the intercompany revenue that we saw on the previous screen. So we have our companies across the top. This is a consolidating report. So we can see Germany, and this is just looking at intercompany planned revenue. So we have Germany here. We have our intercompany revenue with North America of that 120. This is in US dollars now. And then we can go ahead and run our eliminations. And what this will do is it will take that elimination, it will take that intercompany revenue and post an elimination entry at the next common parent within our hierarchy, so that we see that on a consolidated basis. And at this point, we've only gone through and dollarized our intercompany activity again. So we're just focused on that. You can see at a consolidated basis, this 107 here and the 120 has been eliminated and zeroes out in total. So Germany does need to see these intercompany sales as part of their P&L. So same concept if you're just looking at, more of a P&L based, report. These sales are, valid to Germany, and they want to see it on their reports. But when we look at it on a consolidated basis, again, we want to make sure we don't double count North America's sales with Germany's sales. So we see that, eliminated in total here. All right. And then we can launch back into our sales and margin planning process. We can look at different, scenario planning assumptions within the solution as well. Like I mentioned, showed you earlier with the preceding of the data actions and copying from target to budget. If you wanted to evaluate moving production from one facility to another, you could utilize one of those data actions, run a copy package, copy over your standards, from China to a different country, right? Update your drivers and recalculate all the results. And again, you can do that in a matter of minutes for your intercompany plan across your entire company, as opposed to, spending a week or two playing around and modeling these assumptions and then reporting the results out to your companies only to get feedback and have to go and redo it again. So that's all I wanted to show today. Thank you guys for joining us. Hopefully you found this helpful. If you're interested in deploying this for your organization, please, let us know. We'd be happy to help. But hopefully, at minimum, you've learned a few things from the session. And we'll go ahead and open it up for questions for a few minutes if we have any, and then we'll go ahead and wrap up. So if you have any questions, you can go to the questions and add them in the box here. And then always, feel free to reach out to us as well, just via email, and we can get back to you as soon as possible. All right. Well, most of you are still on, maybe waiting to see what other questions people might ask. So hopefully that means I communicated clearly during our time here, and hopefully used your time well. Kept this relatively short for you guys, and I'll give you the rest of the time back. And thanks again for joining, and feel free to reach out to Lauren or myself with any questions.
Thanks, everyone. Take care.
All right. Have a good one.